Welcome everyone to the Stearns Financial live chat. Today's session will be frequently asked questions on the economy and investment landscape. I'm joined today by our co-chief investment officers for SFG, PJ Williams and Glenn Joyce. And so a lot going on. We are going to lean into politics a little bit today. Warning if you have young children in the audience. No, actually, we'll be good about some of the discussions and not use language that won't be appropriate. So let's kick this off. PJ.
So on this first slide, we're just going to provide an update on where things stand with COVID-19. If you've been following the news lately, we've seen really a resurgence across the pond in Europe. On the left here, you can see the daily increase in cases, and you can see just a surge coming out of Europe. And what that's leading to is a reintroduction of lockdowns in certain areas. This week, President Macron from France instituted a public health state of emergency that stated essentially restaurants have to close at 9 p.m. You can't even be gathering people's homes after 9 p.m., kind of a 9 p.m. to 6 a.m. curfew over in the large cities in France. You're seeing Germany and UK consider similar measures just because they've seen such a spike in positive cases in recent days. And in the US, we're seeing something somewhat similar. And again, we all hope it doesn't follow what happened back in March, but we know that Italy, Spain got hit hard first, and the US was right behind that. And so that's something we're monitoring closely. The positive from this, and we'll look at even more on the next slide, but on the right here, you can see daily increase in fatalities. And you can see that Europe did a good job of, we'll call it flattening the curve as they went through the summer months, but now you're seeing it trickle up in the far right in that purple bar in terms of the daily increase in fatalities. And this is looking at the 7-day moving average per million people. So in the US, our population's 350 million or whatever it is today. That's saying that if we're sitting right around 2, that's showing that we're around 70 deaths or 70 deaths per day. And again, and 700. Sorry about the math there. 700 deaths per day. And again, that's well down from where we were back when we were north of 2,000 for a while at the peak. But again, we've never gotten it back to the European levels of being really low. And the hope is that we are kind of in a range here, and hopefully we can continue to push it down and not experience the uptick that you're seeing in Europe. And on this next slide, what we're really focused in on is looking at cases here in the US. And so we've looked at this slide before. The COVID tracking project's providing this data on a daily basis. And you can see as we've increased our number of daily tests, you've seen our daily cases spike up during the summer, and then again we're seeing a trend higher. But really what we want to focus on, and we've been saying this all summer, is focus on the right two graphs, is really looking at hospitalizations and deaths. And so you can see that hospitalizations look very similar from the first peak to the second peak. I won't call it a wave because I'll let the medical experts determine what wave we're in. But so our second peak there was at the same time we had a much higher number of positive cases. And then you look on the far right and you see the peak of deaths was much lower. And so that definitely implies that we are catching it earlier with improved testing and that our treatments and knowledge about the virus is improving. We're all pushing, or the medical community is pushing towards the vaccine as quickly as possible, while also looking at other treatment options. But again, this would imply that we are getting better at treating it. So hopefully, if we do experience a third peak here in hospitalizations and we are trending up again as cases are trending up as we enter the colder months, that we get another lower peak in deaths as we continue to improve our ability to treat patients that become infected with COVID.
Yeah, and some of the high profile cases that we've had lately are people that have a lot of the 47% of Americans with pre-existing conditions that would suggest the death rate could be higher, and they've sailed through, maybe not unscathed, but they've sailed through in better shape than they might have 3 or 4 months ago. So that's good news. So what is this chart telling us, Glenn?
Thanks, Dennis. Yeah, this chart here is very interesting. Right now we've got a little bit of stalemate going on in Congress about the stimulus. And so this chart is focused on the second round of coronavirus stimulus. And what it shows is that it's generally supported across, gender, age, race, ethnicity, and party lines. So it's very interesting that most people, most Americans, feel like we need it. And once again, this stimulus is more, you think about stimuluses in the past, they've been more ways to enhance economic growth. This stimulus, since we're still coming off the lockdown early this year and trying to get the economy back opened up, this stimulus is more about just a lifeline, helping people and small businesses kind of get through this period. And so as you can see, it's widely supported across these different areas. The big debate right now seems to be around the magnitude of it. And there's some political posturing going on as well. I mean, we know the election's coming up, and so both parties want to kind of claim victory here and make sure they're looking like they're doing the right thing. And so the big question is, are we going to get anything before the election, or is it going to be something later? And if it's later, would it be even a larger stimulus perhaps later? That depends on who's in office, and there's a lot of things to debate there, but that's the big story right now leading up to the election. But I think, longer term, we are concerned about the economic health of our country and the debt ratios and just our financial strength. But I think most people right now, as this chart demonstrates, are more focused on short-term needs of getting through this.
And so not as a surprise that we've talked about already, we've talked about the situation with COVID currently. We're going to talk about the election, upcoming slides. Stimulus is a big question mark, but really this is a survey that Bloomberg's reporting on of what are Americans most concerned about. What do they view as the biggest threat in the next 6 months? I don't think any of us would be surprised that the two most significant concerns of Americans that were surveyed are the pandemic at 44% and the election outcome at 34%. So that's almost 80% there. And that is what is top of mind for most Americans. There's a lot of other threats that they see in terms of, terrorism's always going to be there with a small percentage of people, a large decline in the stock market, or just some, black swan event that people aren't even thinking about. Coming into this year, I don't think the average American was thinking about a pandemic being potentially coming to the U.S. So again, there's always things out there that are on people's minds and are concerning. But right now we're in a time where there are two items and situations that are very top of mind for most Americans, and that's the pandemic and the election outcome. And so thinking about that election outcome, this is a Bank of America Global Fund Manager survey. They do these surveys on a regular basis from fund managers around the world in terms of what areas are the most overcrowded or undercrowded to trade. But here the question that was posed to these fund managers was, which U.S. election outcome will cause the maximum market volatility in Q4? And I don't think it will come as a surprise that it is the contested election result. Again, that means the winner, whoever that is, the party or the candidate that is not in a position and is not named the winner, contested via litigation, via some, the Supreme Court's obviously a big issue right now with the confirmation hearings this week and the potential vote coming up. So again, not a surprise that the contested outcome is what's a concern. You can see that number two concern for global fund managers in terms of causing volatility and unease in the market is a Democrat blue wave, so that Democrats maintain Congress, but also win the White House and the Senate. Divided government comes in third, and then a Trump victory, which at this time we don't know whether that would be a Trump Republican president, and we don't know what the Senate would look like, but the overwhelming consensus and its expectation of the Congress will remain blue in the Democrats' hands. So a Trump victory would be a divided government, just as we've had for the last 4 years.
Well, and I think it's interesting. We're on a Strategas briefing the other day, and they're one of the top three best policy research firms in DC, do a lot of strategic work for major entities, and they believe that contested election result is actually less likely, and so a lower probability event, but clearly, if it happened, it's going to get the attentions of the stock market. Let's go to the next one. So Glenn, this is a kind of a busy chart, different variation on one of the ones we had in our written chat recently. Tell us what we're looking at here.
Yes, the written chat you referred to, Dennis, that was one I think that went back to really 1900s, so a little longer time frame. This one really just goes back to post-World War II, 1947. And so what we're looking at is which party was in control, and you can see the top part is around the S&P 500 or the U.S. stock performance. The bottom pane is more around economic growth or real GDP, and it's color coded. Red would be Republican, blue Democrat, and gray is divided government. You see that in the legends on both charts. So I think the message here is, and kind of back to that one you referenced, our written chat, it was pretty much a dead heat when you looked at how the market did, whether you were Republican or Democrat, who was in control, and it was pretty even over that longer time frame. Here it's a little bit nuanced. You got the top pane, at least dating back to 1947, looks like the return's been a little better on the S&P 500 when Republicans have been in control, but still very good on Democrats. So it looks like from a configuration standpoint, we've had good solid results no matter who's been in control. And you can see divided government as well with very solid returns on average. And then if you look at the economy, it's interesting, it flips a little bit, and it was actually a little better economy when the Democrats were in charge. And some of this just kind of, you're dealing with a hand you were dealt, right? It's a timing issue. Whenever you came into office, whether it was a good economy or bad economy, you might have looked better. So there's a lot to consider here, but just some interesting food for thought. There's a lot of uncertainty around who's going to be in charge. And I think people are, anytime that we have uncertainty, the market gets a little bit unsettled because of potential change or not. And so I think it just shows you that maybe we put a little bit too much premium on who's running the show, and it really gets into a lot of other matters like economics and fundamentals and things like that.
So corporate tax rate.
Yeah, I think I got this one too, Dennis. And this one, everybody loves taxes. And so anyway, I think the message here is just looking at the effective corporate tax rate going back really to 1998. And I think the big area to focus on, you guys probably recall in 2017, we had corporate reform, reduced taxes, whatever you want to call it. In 2017, I think the corporate tax rate dropped from like 35% down to 21%. And if you notice here, that took us the blue, kind of the blue line or navy blue is the US. And we were at the top in terms of being at the highest end of the corporate tax rate among our developed market peers. But then that dropped us more down to the middle post 2017. And so it's interesting, we're more around 27%, kind of in between 25 and 30. That just means that when you say corporate tax rate, a lot of times you mean kind of your federal tax rate, which is 21%, but there are other taxes that go into play, just like for individuals have property taxes, sales taxes, et cetera. So it comes out more around 27%. And so I think the message is here, if you think back what happened, it was very interesting. Right after that happened and they announced it, we were actually seeing some of the international stocks continue to lead. And it wasn't until it went into effect late in the fourth quarter of 2017 that we started really seeing some positive momentum from US stocks. So we do know lower tax rates are good for profit margins. And so generally that's a tailwind for businesses. But even if, Biden's talked about maybe raising that if he gets in office, maybe back up closer to 28%. So even if that did occur, we would still be much lower than we were pre-2017. And we do know that corporations are great at finding ways to continue to generate profit. And right now, I would submit we really need economic growth just to be revitalized. We need to get back to full strength, and that would help kind of rise all ships or all boats. And so a lot to consider there, but we have been thinking about our U.S. international stock balance. And this could be another thing that might make international stocks a little more appealing if our rates rise a little bit and some of the foreign rates stay the same. Of course, you got to decide where they're going to stay the same, and that's up for debate as well. But it's just another thing to think about as we go forward. But I think, once again, we will not be going all the way back up. We don't project back up to where we were. It's just a matter of where we go and who gets in office and what the decision ultimately is.
Yeah, and all good points, Glenn. And again, some of the info from Strategos the other day was that what they called a false narrative on Wall Street right now, that the Biden increases in corporate rates are not all that different than what happened a couple other times in the last 30 years. And we survived those other times. They point out that at least what's been proposed is a much bigger magnitude. And there are some companies, in particular technology companies, that may be even more subject to some of that. And so really the question is, and again, this assumes, we have underlined this a number of times, that we have the blue wave. And this assumes that it's all implemented in 2021 in terms of the increase in taxes. And there is at least some intelligence data that suggests some staggering, but we'll have to wait and see how that works out. Okay, next slide. Performance by sector.
Yeah, my mom used to love the saying, a picture says 1,000 words or conveys 1,000 words, and I think it's very appropriate here. You look here, we're looking at the stock market performance, really year to date through October 14th. And it just shows you the disparity across sectors and industries. You can kind of find about 8 over from the left is the SP 500, and it's up about 10% year to date, at least through mid-October. So a solid performance. It actually weakened. We had a little bit of a pullback, nothing major, but a little bit of pullback in September. But as we discussed, it's been strengthening as we start approaching the election, which is somewhat of a surprise. We're seeing some good momentum here this month. And so, but you just look and you're like, where your position really matters. I mean, if you think about, if you're concentrated in certain areas, you've had a whole different experience from somebody if they were concentrated in another area. For example, you look to the left and there's just a sort of wide gap from online retail up 71% over to energy down 47%. I mean, that's a huge gap. And so you kind of understand what's been working and what hasn't. The things that have been working are things that can be online or technology related, like online retail, home improvement, information technology, groceries, but then things with a little more social dependence or reliance on people getting together and assembling, like airlines, leisure, real estate, and then of course energy. We know what's happened there. Those have had really tough times. Now, what's interesting going forward would be, if we do start seeing this opening up continue, and we are concerned about some of the rising COVID cases we've been hearing about, but if we can continue to, in some fashion, get the economy back going, there could be a rotation. We may see, money, or at least folks focusing a little more away from what's been really, really working, like technology, maybe to some of these other areas if there's kind of rebound potential as we open up. But a lot of it gets back to when that occurs, and there's a lot between here and getting back up to full strength. But those are areas that we're at least considering as we think about how to move forward.
And I'm sure a few people are looking at this chart and going, wait a minute, restaurants are positive? And just in the last week, we've had several high-profile restaurants that are just on fire in terms of their stock, and several high-profile people saying, okay, that's crazy. Again, I think their frothiness is not just in the technology sector. The other interesting piece is that online retail, Amazon, is probably exhibit number one that would be affected by a rising corporate tax rate, because they have one of the lower corporate tax rates out there. All right. PJ, you're going to take home?
Yeah, so on this slide, what we're looking at is a report that was provided by FactSet. And we talked about this earlier, really when, COVID first hit, when we got into March and April, we really started to see many corporations stop talking about forward guidance for their earnings, just because they don't have that crystal ball. Things became very murky, and they're still murky with the state of the opening of the economy and with where the COVID virus is going, in terms of where that's taking us in terms of potential re-lockdown or taking a step back. And so what FactSet did on this slide is they took 285 companies that they typically believe that those companies usually provide forward guidance. So, talking about earnings in the future and what their expectations are, it kind of sets a bar for what the market expects for them and what analysts expect. Usually they try to set the bar a little low, be conservative so they can hop over it. Hopefully that gives them a pop in their stock price. But with what FactSet did is they took those 285 companies that are a subset of the S&P 500, and they looked at them and reviewed the transcripts from their earnings calls during Q2 or following Q2. So looking back at Q2 earnings and then projecting forward throughout the rest of 2020 and into 2021. And they found that over half of those 285 companies that typically provided guidance have pulled guidance. Again, not surprised given just the unknowns of where we're going, not only with the virus and the economy, but the election coming up as well. And so you can see that starting with the left, some of the areas that are definitely not providing it, consumer discretionary, not surprising there. There's just so much unknowns. Are we going to get our stimulus package? Well, if we do, that would potentially improve the state of some of these consumer discretionary companies with people having more money in their pockets to spend. But it's unknown on what the magnitude is, where it's going to be targeted, and when it might come. And then you go to the far right and you see utilities. They're all providing guidance. Again, utilities are probably a business that's easier to forecast. And there is an expectation, given the service they're providing, that they will provide that guidance. But this is just another example of how much unknown is out there when we're looking forward, just given the unknown state of the vaccine and when that will come, and then what that means for who's able to take it. Is it able to be given widely? Are people willing to take it widely? And so there's a lot of unknowns, and that leads these management teams at these corporations to say, we are not going to put anything out there at this time until we have more clarity on where things are headed with our business.
So PJ, how do you sync this slide up and everything you just talked about with Goldman Sachs' most recent forecast, as recently as a week and a half ago, where they're pretty darn positive? I know they have cranked up their intelligence gathering network, and they are gathering a lot of data real time to try to figure out where things on this chart are going. And they came out with a pretty high conviction forecast that regardless of who wins, Biden or Trump, that mid 2021, we're going to have a 8, 10, 12% uptick in the US stock market. And some sectors, again, doing better than others. So how do you juxtapose their higher level of conviction right now with the fact that many of the actual management teams of these companies are playing it a little more close to the vest and cagey about where they think their earnings are going to go?
I think a big piece of that is Goldman's coming at it with that report from more of a macro perspective. These management teams are sitting inside their own corporations, looking at what do we think is going to happen, and they are hesitant for probably their own, let's not call it business risk, but stock price risk, and maybe there's some career risk they're seeing. They don't want to be very wrong, and so they're taking we don't have to produce earnings estimates or forward guidance. There's no requirement for many of these companies that they do that. So we're just going to take the conservative approach and not put anything out there. Goldman's looking at expectations of a vaccine becoming available and working its way through the population. They're looking at the fact that they are not concerned outside of a contested election that a change, whether it be a continuation of Trump or that Biden gets elected, they're not concerned that either of those outcomes would be detrimental to the economy or stock market in the short run. They're looking at the fact that interest rates are low and are expected to stay low, which again is something else that if investors are out there looking at, what asset class do I want to invest in? Well, fixed income, we know right now continues to be a place where it's hard to see getting too much more than 1% on your 10-year bond anytime soon, unless rates go to zero, because the 10 years trading, the yield on a new 10-year bond is around 75 basis points right now. And so Goldman's looking at all of those factors and looking at the stock market as a whole, and they're saying these things can be tailwinds to the market. But when you get to the micro level and these company management teams, they're just unwilling and probably taking the conservative approach of let's not put anything out there that could be very wrong if the virus takes a turn one way or the other. Vaccine comes out earlier, maybe they're way low on their estimates, or they're probably more concerned about, we do get a true second wave and we do take steps back and shutting down the economy, and they fall well short of their estimates.
The other thing I would add, Dennis, the big question is, what do we look like on the other side of this? And, what does normal, if there's a normal, look like if we kind of get back to at least what we consider full strength for the economy? But even if we get back to, back above our gross domestic product number in terms of getting back above that from an economic strength perspective, there's going to be a different composition here. Like we saw on the previous chart, some sectors will be back above where they were, in February of 19 or February of 20. And then there's going to be some sectors that maybe haven't still fully recovered just because there's so much that's got to be done in terms of getting them back at the full speed with all the social dependence. And we know that there's going to be some permanent job loss, and some businesses are just not going to reopen. And so that's where it gets very tricky. We had very historically low unemployment. We know consumer strength or consumer spending is what drives the U.S. economy. About 2/3 or more of the economic growth is relying on spending. And so we're not projecting we're going to get back to that unemployment rate anytime soon. It's going to probably be a while before we get back down below 4%. Who knows when exactly? Those folks will have to reassimilate and find new careers. So it's going to be a challenge, I think in some regards, but at the same time, from a market perspective, some of these companies are finding ways to move forward, and there's going to be, things born out of this where companies adopt new strategies that may be very effective. And we do know interest rates are much lower now, even before COVID. So once you have low interest rates, that's usually very positive for the stock market. So there's just a lot of crosswinds going on right now, both from the economic side of the ledger and also from the stock market side. So I think, as long as interest rates are low, I think that will help out the market. But once again, we got to kind of see some of the economic data come through and see when we can kind of get back people back to work and businesses back open. So still a lot of uncertainty over the next few months.
Yeah, all good points. And we've gotten more intelligence data that companies are using the pandemic to accelerate their automation and robotics and all kinds of other technology accelerators, and creating a leaner income statement, cutting some of their expenses. And that happens every time we get into this type of situation. And so that, if you're a shareholder, that's beneficial coming out the back end of a recession. That means your earnings have the ability to grow at a faster rate. If you're inside those companies, and we have a number of clients in some of those companies, it may not be so great. Or, we have one situation where a client's being asked to do 1.5 jobs now at no increase in pay. And so there's all kinds of other things that are going on as the pandemic economy pivots towards whatever the end game is going to look like. So we have a, well, I guess this is more of a statement than a question about Chipotle is up so much this year. Is it still a buy? I don't know that we maintain coverage on Chipotle. And I don't know that we're doing individual stock forecasting here on restaurant stocks. But do either of you have an opinion on Chipotle?
They've had a great comeback from their health incidents from a couple of years ago. So, and I do like their food, but I'm not going to comment on whether it's a buy or sell at this point. But they have had a good comeback from what was a couple of bad situations on the health side that were widespread.
All right, we have a recommendation for lunch, but not necessarily the stock. All right. Well, and so the possibility of a contested election, PJ, you mentioned that Goldman Sachs is not really keen on that as far as the stock market. What do you think that might look like in volatility? We saw that earlier slide that said that that's the number one concern of investment managers surveyed.
I mean, I think the biggest thing at that point in time here, as we, first off, when will we get an announced winner? Again, we know that this is going to probably be the most mail-in ballots ever received for an election. So, do we have any hiccups, especially on any battleground states in terms of counting and just, delayed results that we're not going to know the night of November 3rd, maybe? So we'll see where it is. But I think, if you get to that point where a winner is announced and it's contested by the other side, whoever that is, it's all about the duration at that point. Are we still talking about this and no definitive answer in December, as it's maybe in the courts at that point? So again, I think the duration is the biggest key in terms of how much volatility can it create, and what does that mean for not only the markets, but also the state of our country. We've had a rough year on various fronts this year. That would just lead to another event in 2020 that is just not good, as the country looks more divided. And again, so I think we all hope that regardless of who the winner is, that it is announced readily, and as quickly as possible, either on the night of November 3rd or soon thereafter, and that it's accepted by the other side. And so I think that's all we can ask for.
Okay. And should be noted that Strategas, they again believe that the chances of that contested election have actually dropped some recently. And number two, it was kind of interesting. They said, watch Florida. Florida apparently counts a lot more of their mail-in votes real time, and they did not expect another, what was it called back some years ago, the hanging Chad,
Yep.
hanging Chad thing.
Mhm.
And so they said, Florida could be one of those key battleground states early on. Yeah, I'm sure that the election coverage, they will be surveying wildlife as they come out of the forest. They seem to, the media seems to be going a little over the top on this one. And so everyone will have the ability to tune in or tune out as your own mental health can do well with. So with that, any closing comments, PJ or Glenn?
I mean, I think we've talked about today. Then the next month, 2 months are very crucial on the healthcare side, that we see improvements in treatment and/or progress on the vaccine as it goes through phase 3 trials, and that we don't see a tick up in the deaths. And then obviously we all know that the next couple of weeks will be very interesting as we get closer to and past the election.
Glenn, any final comments?
Yeah, I don't think so. I mean, I think the main thing, I think I've said this a few times in the past on past past chats. I think it's just very incumbent on folks to continue to focus on the strategy and make sure they're in the right strategy, because it's times like these where you just want to make sure that the strategy is aligned with your goals, your long-term goals. And so we're always trying to check in with clients when we have meetings and just make sure that that they are in the right strategy and they understand the risk, because these volatile times where we obviously want to make sure that's the case, because we all know that it just creates anxiety and creates usually counterproductive habits. And so I'll just leave it with that.
Good way to wind this chat up. Well, thank you, Glenn. Thank you, PJ. And thanks for our audience and some of your questions. As usual, this is being recorded, and that recording will be available on our YouTube channel or sent out to you as a follow-up for you to be able to watch at your leisure. And we look forward to your continuing frequently asked questions. Thank you very much. Have a great weekend.